Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Vertex Pharmaceuticals, ticker symbol VRTX.
And if you are looking for a company making probably the biggest, most aggressive pivot in biotech right now, this is it. You found it. VRTX isn't just evolving, it's trying to execute a complete corporate transformation.
That's exactly right. And the mandatory thesis statement here is, I think, really clear and very high stakes.
It is.
VRTX is betting its $12.0 billion cash hoard and 11% Q3 revenue growth will successfully pivot from CF dominance to a multi-franchise powerhouse, positioning for multiple 2026 regulatory filings despite past acquisition failures, highlighted by a $379 million impairment and NOPAIN Act friction on its acute pain launch.
And that is a phenomenal place to start because for you, the listener, this is about so much more than just a quarterly report. This is a company actively leveraging a massive self-generated monopoly, their cystic fibrosis business, to jump into entirely new therapeutic areas.
Right. We're talking kidney disease, diabetes, next-generation pain management.
Exactly. So the mission here today is to decide if that financial security is being used wisely or if they are simply using their CF cash flow to underwrite some really high-risk R&D that, frankly, might already be priced into the stock.
I think the most important thing to grasp before we even touch the pipeline is the sheer scale of the financial bedrock they're standing on. You can't attempt a transformation like this without deep, deep pockets, and VRTX definitely has them.
Absolutely. When we talk about the financial foundation, it's really two things. First, you have consistent high-margin revenue from the legacy business, and second, you have just unparalleled liquidity.
Okay, so let's look at Q3 2025. What do the numbers say?
Total revenue hit a very robust $3.08 billion for the quarter. That's an 11% year-over-year increase. And that's off an already massive base. It shows the CF franchise isn't slowing down. It's still finding new pockets of growth all over the world.
But the number that really dictates their strategic freedom, that's the cash on hand.
That's the one. As of the end of Q3 2025, they were sitting on a staggering $12 billion in total cash equivalents, and marketable securities.
$12 billion. That's M&A optionality. It's insulation from clinical failure, and it's the ability to dictate your own timelines, all rolled into one massive war chest.
It creates a really unique position in biotech. I mean, most companies are out there raising funds for specific trial stages. Vertex just generates its own billions in profit and deploys it strategically. We see them using it for share repurchases. They approved a $4.0 billion program back in May 2025, but more importantly, they're plowing it back into the future of the company.
Which brings us to the strategic cost of this growth plan.
Yes, and that cost is not subtle. Management didn't shy away from it. They updated their full-year 2025 guidance for combined non-GAAP R&D, acquired IPR&D, and SG&A expenses.
Rent up between $5.0 billion and $5.1 billion. That is an enormous amount of capital being burned on development and, I guess, getting ready for commercial launch.
That raised guidance is the single clearest signal of management's conviction. It tells you they're hitting the gas pedal on the most promising assets. This increase, it reflects accelerated investment into their commercial infrastructure for the new launches, JOURNAVX, ALYFTREK, CASGEVY. But most significantly, it's about speeding up development for pivotal assets like Povetacicept.
Povetacicept or Pove?
Pove, right. They are rushing these multi-billion-dollar opportunities toward regulatory filings.
Okay, I want to focus on a piece of financial jargon we mentioned in the thesis, because I think it unlocks the whole story of how they're approaching risk. The $4.4 billion acquired in-process R&D charge, that's an AIPR&D charge. For anyone listening who hasn't dealt with accounting arcana, can you explain why this is so critical?
This is so crucial. When Vertex bought Alpine Immune Sciences, which is what gave them Pove, they paid $4.4 billion, mostly for a drug that hadn't finished development yet. So accounting rules require that if an acquired asset has no alternative future use and hasn't hit regulatory approval, the company has to expense that cost immediately. That's what generated the $4.4 billion AIPR&D charge back in 2024.
So it's a huge paper loss, but it's a strategic choice.
Exactly. It's a massive, non-deductible paper loss that just screams management's absolute confidence in this asset.
Yeah.
So when we look at the financials, this is why the year-to-date net income for the first 9 months of 2025 is a very healthy $2.76 billion.
Right.
But if you look back at the same period last year, because of that $4.4 billion charge, the company actually reported a substantial pre-tax loss. They were willing to swallow a multi-billion-dollar charge, basically erase a year's worth of profit on paper, just to secure Pove.
That level of conviction really defines their strategy right now. They're prioritizing future blockbusters over near-term paper profitability.
It's an aggressive but calculated move, and it explains why the street is so bullish despite the massive R&D outlay. They can afford it. I mean, their trailing 12 months revenue is still $11.4 billion, which yields a TTM net income of $3.6 billion.
And the margins are still just astronomical for a company spending this much.
A gross margin of 86.1%. That's what allows them to run their R&D intensity up to 33.6% of revenue. They are a profit machine that is just fueling an R&D furnace.
And that furnace only stays hot if the CF engine keeps running. So
Yeah.
let's talk about that foundation, the CF bedrock, and specifically their next-gen drug, ALYFTREK.
Right. ALYFTREK is the cornerstone. It's the next-generation CFTR modulator, approved for patients 6 and older, and it's designed to gradually replace their existing monster blockbuster, Trikafta.
And how's that launch going?
The initial commercialization is extremely strong. The Q3 revenue anchor point we have is $247 million. And in its first 10 months, the product generated close to $500 million in sales. That shows immediate physician uptake and very rapid payer approval.
The story around this drug seems to be about convenience and improved efficacy. How important is that for getting patients to switch over?
It's strategic. The company explicitly expects the transition of most Trikafta patients to ALYFTREK over time. And it makes sense. ALYFTREK offers once-daily dosing that immediately improves adherence and quality of life.
Sure.
And crucially, the clinical data suggests it drives sweat chloride levels down to the lowest levels ever seen for a modulator in this age group, which shows improved CFTR function. For a patient managing a lifelong illness, that combo of max efficacy and less burden is incredibly persuasive.
And they're not just switching patients, they're capturing new ones as well.
Absolutely. The label expansion for ALYFTREK has brought in about 400 more eligible patients in the U.S. and over 4,000 more outside the U.S. So this isn't just swapping one successful drug for another, it's expanding their total addressable market, especially as they get reimbursement in key markets like England and Germany.
Okay, so the CF franchise is the reliable source of capital. It's what's insulating them from the volatility of these newer, high-risk launches. Let's get into those new launches.
Let's do it.
The first big commercial effort outside CF is in acute pain with JOURNAVX. That's suzetrigine. It's the first-in-class non-opioid NaV1.8 inhibitor. The adoption rate looks pretty aggressive.
It's been remarkably rapid. You can literally chart the exponential curve here. It was 10,000 prescriptions in Q1, then 90,000 in Q2, and then it jumped to over 170,000 prescriptions in Q3 2025.
Wow.
And by early Q4, the cumulative count was already over 300,000 prescriptions. This suggests physicians are really incorporating it into surgical protocols, into emergency departments, recognizing that it offers opioid-level efficacy without the addiction risk and the awful GI side effects.
But rapid adoption doesn't mean easy revenue, especially if the payer landscape is tricky. You mentioned friction here, and this is where that commercial execution risk really starts to show up.
It does. I mean, Vertex has secured access for nearly 170 million covered lives, which is a massive chunk of the U.S. market. And they've secured formal coverage with 2 out of the 3 big national pharmacy benefit managers, the PBMs. That's a success. But the struggle isn't just getting coverage, it's securing unrestricted coverage. An acute pain patient needs medicine right away. They can't wait for a prior authorization or go through step edits. So maximizing penetration means converting that third large PBM and eliminating those barriers for the other 2. That's still a significant commercial challenge.
And then there's the NOPAIN Act. Why does VRTX care so much about this, especially if the direct financial impact is supposedly small?
Right. So the NOPAIN Act is designed to encourage hospitals to use non-opioid treatments by offering them add-on payments for Medicare patients. VRTX is fighting hard for JOURNAVX's inclusion on that list. And while management says the financial impact is minimal, less than 2% of the opportunity, the importance is really symbolic.
It's a stamp of approval.
It's a huge stamp of approval. Inclusion standardizes reimbursement, it simplifies formulary adoption, and it's a powerful public signal that this is exactly the kind of alternative Congress wanted to promote. The delay in the final list just keeps this friction point active.
Okay, shifting gears pretty dramatically now. Let's talk about the next launch. Gene editing with CASGEVY. This is for severe sickle cell disease and beta thalassemia. It's positioned as a potential functional cure. What makes this launch so different?
Well, CASGEVY is truly transformative. It's a one-time functional cure. The approvals are secured globally. Reimbursement is set in 10 countries. And Vertex has hit its logistical goal, activating 75 authorized treatment centers, or ATCs, globally. These are specialized centers that can deliver this complex therapy.
Given that it's a life-changing treatment, the adoption rate seems surprisingly slow. Only 29 patients have received infusions so far, with just 10 in the third quarter. Why is there a bottleneck?
The bottleneck is all logistics and patient readiness. This isn't a pill. It's an ex vivo cell therapy. It requires the patient to undergo cell collection. The cells get shipped, edited, returned, and then the patient has to go through myeloablative conditioning, basically chemo before the infusion.
So that's a huge commitment.
A massive commitment. It requires specialized centers, complex scheduling, long manufacturing lead times. So while Vertex has done the groundwork with the ATCs, scaling patient throughput in a system like that is just inherently slow.
So even with the potential cure, the revenue ramp is going to be pretty gradual. They're projecting over $100 million in CASGEVY revenue for all of 2025. Is that a success or is that a disappointment for a gene therapy?
I'd call it a success in signaling, but it's modest financially. It proves VRTX can execute on these incredibly complex cell and gene therapy logistics, which is critical for their future programs like in T1D, but it reinforces that the real revenue engine for diversification, it's not going to come from gene editing in the near term. The financial future really hinges on the scale of their two pivotal bets, and that's where the bulk of that $5.1 billion in spending is going.
Which brings us to the monumental pivots. The renal bet with POVE and the diabetes bet with VX-880. These are the assets that really dictate the company's valuation premium. Let's start with Povetacicept, POVE, the drug they spent $4.4 billion on. What is it and what makes it potentially best in class?
POVE is a dual BAF and APRIL inhibitor. So to break down the science a bit, BAF and APRIL are two cytokines that act as survival factors for B cells and plasma cells, the immune cells that produce these pathogenic antibodies. In diseases like IgA nephropathy or IgAN, those antibodies damage the kidneys.
So by inhibiting both BAF and APRIL, what's the scientific advantage there compared to a competitor who might only hit one of them?
The thinking is that by blocking both pathways, you get a more comprehensive, a deeper, and a more sustained reduction in the bad plasma cells and autoantibodies. POVE was specifically engineered for superior potency and high tissue distribution. That means it's optimized to get to the glomerulus, the filtering unit of the kidney where all the damage is happening.
For targeting the root cause.
It's targeting the root cause of the autoimmune disease, moving way beyond just managing symptoms.
The IgAN market is huge, and it seems like VRTX is moving at lightning speed here. Tell me about the enrollment for the Phase 3 RAINIER trial.
The clinical momentum is undeniable. IgAN affects over 300,000 patients in the U.S. and Europe. It's a multi-billion-dollar opportunity. Vertex completed enrollment for their interim analysis cohort in September of 2025. Total enrollment was over 600 patients in under 15 months.
And that's fast.
To put that in context, that's the fastest contemporary IgAN trial enrollment ever achieved. That pace speaks to the massive unmet need and the excitement around this drug's mechanism.
And the reward for that speed is a potentially very quick route to market.
Exactly. That 36-week interim analysis data could be the foundation for a U.S. accelerated approval filing in the first half of 2026. If that's successful, it puts VRTX on the market potentially ahead of competitors, but with a really unique differentiator.
Which is patient convenience. Let's talk about that, because in crowded markets, the delivery mechanism can be the deciding factor.
Absolutely. Competitors might require IV infusions or more complex regimens. POVE is designed for once-monthly subcutaneous dosing. It's a small auto-injector with a tiny volume of just 0.46 millimol.
So patients can do it themselves at home.
Exactly. A self-administered monthly low-volume injection that is highly patient-preferred. You combine that ease of use with the promising Phase 2 data, and you've got a blockbuster opportunity.
And we have to emphasize, this is a pipeline and a product strategy. IgAN is just the beginning.
Correct. POVE is built for multiple B-cell-mediated autoimmune diseases. Pivotal development is also starting soon for primary membranous nephropathy, PMN, another serious kidney disorder. Beyond renal, they've prioritized generalized myasthenia gravis, GMG, and warm autoimmune hemolytic anemia, WAIHA. Next, leveraging one molecule across 4 or 5 major indications. That's how you justify the current valuation.
Okay, now for the second monumental pivot, the diabetes bet. Zimislecel, VX-880 for type 1 diabetes. This moves VRTX into cell therapy as a potential functional cure, and the Phase 12 data was Well, it was stunning.
Stunning is the right word. For severe T1D patients, the outcome was transformative. In that phase 12 study of the 12 full-dose participants with at least a year of follow-up, 10 of them, that's 83%, achieved insulin independence at month 12.
Insulin independence. I mean, just think about the life-changing impact of that. Eliminating daily insulin, the severe blood sugar crashes, the constant monitoring.
And even for the two who didn't achieve full independence, the results were still overwhelmingly positive. All 12 participants achieved the primary endpoint. They eliminated severe hypoglycemic events, those dangerous crashes, and they got their HbA1c below 7%. They also had a mean reduction of 92% in their insulin use. This is a legitimate functional cure candidate.
So what's the timeline for this? And what's the trade-off? There has to be one.
The timeline is aggressive, just like with Poving. Phase 3 enrollment is complete, and they're planning for global regulatory submissions in 2026. The initial launch target is the roughly 60,000 severe T1D patients who are at high risk. The trade-off, though, is that this currently requires continuous immunosuppressive therapy to keep the body from rejecting the implanted cells.
And that reliance on immunosuppression is a major hurdle. It limits the patient population to the sickest of the sick. You can't target the broader T1D population that way. Is Vertex working on that problem?
They have to be, because that's where the real money is. They're actively researching other approaches, like developing hypoimmune islet cells that are genetically modified to hide from the immune system, and novel encapsulation techniques. Their willingness to invest in both the commercial asset and the next-gen R&D to remove that hurdle shows a real long-term commitment to owning this space.
This all sets up a really charged discussion about pipeline depth and, crucially, execution risk. The excitement is high, but we have to balance that with the realistic hurdles and, past failures.
We must. While these programs are transformative, development is inherently perilous, and VRTX has already had recent failures, confirming that even the best science and the biggest cash pile don't guarantee success. But first, let's briefly touch on the remaining pipeline, starting with the pain franchise.
Right. VRTX is determined to move JOURNAVX from acute pain into the much larger chronic pain market. Their top priority there is diabetic peripheral neuropathy, or DPN.
DPN is a massive target. It's a large chronic market, with about 2 million plus patients in the U.S. alone, a multi-billion-dollar opportunity. The challenge is that the FDA requires 2 successful pivotal studies for a DPN label. So VRTX is initiating a second, smaller phase 3 study to get that indication as quickly as possible.
And when do we see data from that?
Enrollment in both of those DPN phase 3 studies is expected to complete by late 2026. So that positions chronic pain as another major catalyst in the 2027 timeframe.
They're also investing in other modalities like oligonucleotides, right?
Yes, exactly. They're developing the DM1 asset, VX-670, for myotonic dystrophy type 1. Phase 12 enrollment and dosing for that is expected to complete in the first half of 2026. It shows that even while they're concentrating resources on the big 4 CF, pain, renal, diabetes, they're still seeding the future pipeline.
Okay. Now for the setbacks. We saw the $4.4 billion AIPR&D charge, which was a calculated risk. But we've also seen genuine pipeline failures that resulted in a financial impairment. Tell us about the T1D program that failed.
Vertex recorded a substantial $379 million intangible asset impairment charge in Q1 2025. That was due to the discontinuation of their VX-264 T1D program. This was another diabetes asset, one that was intended to be part of the portfolio, potentially to avoid immunosuppression, but it didn't work out in the clinic.
So that impairment charge is the accounting consequence of realizing that the investment was lost.
It's a painful but necessary reminder that for every POV or VX-880 success, there are failures that cost hundreds of millions of dollars.
That amount of capital loss, $379 million on a single program, must make investors nervous, especially when the valuation is built on R&D success. Is that a sign of recklessness or just the cost of doing aggressive science?
I think it's the normal cost of doing aggressive science at this scale, but it introduces necessary tension into the investment case. They failed on one diabetes program and are pouring billions into another. The market is giving them a pass because of the CF revenue, but these are material failures.
And it's not the only one.
Not at all. Their pain pipeline also had a setback with their next-gen asset, VX-993. It failed to meet its primary endpoint in a phase 2 acute pain study.
So the first product, JOURNAVX, worked, but the next iteration failed. What was the company's reasoning for that?
Management explained that inhibiting the NaV 1.8 channel probably reached its maximum therapeutic benefit with JOURNAVX. And trying to go higher up the potency curve with VX-993 just didn't yield better results. They basically hit a ceiling. While VX-993 is continuing in a study for chronic DPN, its failure in the acute setting shows that even incremental improvements are fraught with risk.
And finally, let's revisit that commercial execution risk. We talked about JOURNAVX's rapid prescription growth, but that means nothing if they can't clear the final hurdle of getting unrestricted payer coverage.
That's the lingering risk. They have access for 170 million lives, but success is measured by eliminating those prior authorizations and step edits. The key challenge is securing that third big national PBM. Failure to get unrestricted access means VRTX has to spend more on sales, education, and patient assistance to overcome those barriers.
It's commercial risk and not clinical risk, but it directly hits the profitability of their first big attempt at a primary care market.
Exactly. They proved the science works. Now they have to prove the commercial machine works outside the CF cocoon.
So after this deep dive, from the $12 billion war chest and the $5.1 billion spending plan to these huge R&D bets and the execution setbacks, we have to synthesize the investment case. What is the core conflict here for an investor?
The core conflict is the massive strategic bet being placed on speed. Vertex has unmatched stability from CF, and it's using that advantage to accelerate 4 pivotal transformative programs: IgAN, T1D, chronic pain, and PMN. The question isn't whether they have the capital to do the science, but whether the required success rate across these 4 highly uncertain programs justifies the current high valuation.
When we look at the potential reward, it is genuinely colossal. We're talking about Povetacicept, a potential best-in-class biologic targeting the cause of kidney disease for over 300,000 patients. And VX-880, a potential functional cure in severe T1D. I mean, these are portfolio-defining assets. Does that reward justify the premium the market is assigning?
It justifies the risk, yes, but not necessarily the certainty that's implied by the valuation. Investors are paying a premium for high inherent clinical uncertainty. The aggressive acceleration of these programs, reflected in that raised $5.1 billion expense guidance, means VRTX is pulling revenue forward, expecting successful submissions in 2026.
But if you pay that premium,
You're betting that the encouraging Phase 2 data will translate flawlessly into Phase 3 success. If even one of these 4 pivotal programs fails or gets a significant delay, it could profoundly impact the stock price, because the market is currently pricing in a very high probability of success for all of them.
So the ultimate investment case hinges on VRTX successfully executing the ultimate pivot, shifting from relying solely on small molecule dominance in one organ system, the lung and CF, to conquering cell, gene, and biologic approaches across 3 major new disease areas. It's a remarkable transformation effort that is, frankly, just breathtaking in its ambition.
And in its required execution. They've defined the high reward, now they have to deliver on the operational and clinical risk.
Risk defined, portfolio protected.